SAIL. That's the stock we're putting a spotlight on today. And what's interesting is that it has actually attracted the highest sell calls from analysts versus the peers. Now, this comes despite the stock actually posted an impressive 7% uptick last week. Today itself, the stock is up a little over 2.5% as well. The critical question from here on is whether this rally has the staying power, or is it merely a short-lived surge that we've seen over the last 2 trading sessions? Mika joins us with the analysis. Mika, clearly, last week, Friday was a strong one. Today as well, the stock is trading in the positive. And you have analysts which have given the highest sell call to the counter. What is the story that the investors should be watching out for?
So when you compare Steel Authority of India to its other peers, something like a Tata Steel, JSW Steel and Jindal Steel and Power, well, SAIL actually has the highest percentage of sell ratings. Around 19 analysts out of 14 analysts out of 29 analysts tracking the stock currently have a sell rating on the counter, versus only 17 to 29% of the analysts tracking its peers have a sell call on those counters. Now, yes, we've seen an uptick today as well as a 7% uptick last week. This was mainly driven by 2 factors. One is a potential 12% safeguard duty on steel, which benefits sales volumes the most because it has a higher share of flat steel products, and at that point it had better valuation versus peers. However, the spotlight does come on the mid to long-term concerns and whether this is just a short-lived uptick. If you look at historically, SAIL has underperformed its peers in the 1-year period. As of Friday, SAIL was down 10% in the 1-year period versus Tata Steel, JSW Steel and JSPL, which have seen gains of 6 to 30%. This is amid the kind of stock correction we've seen in the past few months. Even in the 5-year period, everyone has posted positive returns, but SAIL stands the least at 330% versus other counters that have gained over 400 to almost 800%. Now, the key concern is actually their capacity expansion. They plan to expand their capacity to 35 MTPA versus 20 MTPA right now by FY31. This entails a high capex plan of 1.1 to 1.2 lakh crore rupees. And however, on the other side, analysts do expect that the capacity expansion will only hit 28 MTPA by FY31. And the biggest concern around this capacity expansion is how it would impact the balance sheet. Now, expansion capex is set to start from next year, and high capex is expected to burden an already weak balance sheet as per MK and as well as Kotak Securities. Even in their previous historical expansion phase that lasted from FY10 to FY20, the expansion phase led to a 9 to 10 years of negative cash flows. Now, if you look at the debt and liquidity picture as of H1, the company has a total of 35,600 odd crores of total debt, whereas the cash and balance stands at only 68 crore rupees. Even if you look at how it's changed from FY24 and FY23, the total debt has increased 16% versus the end of FY24 and has increased 39% versus the end of FY23. And their cash balance, on the other hand, has actually fallen when you compare it to FY24. And whereas for FY23, we've seen an uptick of 20% to 68 crores versus 50 odd crores in FY23. But the cash flow picture is what's turned negative actually. H1 FY25, we saw cash flows turn negative to around 1,100 crores versus positive cash flows of 2,900 crores in FY24. And even before that, FY22, FY23, we had positive cash flows. But the net cash flows have also been very volatile, and that's where the current liquidity picture looks like. The H1 FY25 cash flow from operations actually turned negative because of 3 main reasons. One is overall lower net profits. Second is higher joint venture losses posted by the company, as well as higher financial liabilities, as well as trade payables.